There are many reasons companies want to put their best financial foot forward when interacting with banks and investors. When looking for the best investments, people look for profitability along with stability. Lenders do the same thing when issuing loans. Who has a good track record? Who is the best bet? To determine a company's profitability, potential investors look at their financial statements, specifically their earnings and cash flow. Just like we use a variety of strategies to present our best selves during an interview, companies do the same to present their earnings in the most positive light in their financial statements. These practices are known as earnings management. While legal and acceptable under GAAP, or Generally Accepted Accounting Principles, care must be taken that earnings management doesn't cross a line into fraud. For example, companies can manage earnings by timing activities or the reporting of those activities on their financial statements. But earnings management becomes fraud if the company intentionally mistakes information in their financial reports. Accounts receivable refers to the money owed to a company. For example, let's say you operate a company that designs and manufactures sneakers. Your latest design is very popular and a large chain has ordered 10,000 units at $50 per unit. Great news, that's a $500,000 sale, but that chain isn't going to pay you up front before receiving their shoes. Or let's say you allow your customers to open lines of credit so they can purchase your sneakers and pay over time. In both of these examples, the amount of the sale is recorded as a receivable, or money that will be received on the line. Companies often use receivables in earnings management to change when revenue is recorded. For example, if revenues are deferred until the next year's financials, it might lower the amount of taxes a company owes in the current year. If receivable revenues are accounted for in the current year, it increases the value of the company. This could help them secure a more favorable loan or increase the company's sale price in a merger. No business is immune to bad debt. Sometimes companies extend credit to customers who can't pay, or sales fall through. Bad debts are typically entered in as receivables on an estimate. But since bad debts are accounted for as estimates, a company can apply certain methods, such as changing due dates or the amounts considered uncollectible, in order to manage their earnings. For example, when using the income statement method, bad debt is accounted for as estimated percentage of credit sales. Switching to the balance sheet method allows a company to spread the bad debt estimate across 3 accounts receivable groups instead. If a company has a reasonable expectation the estimated percentage of bad debt will change in a given year, this too can be used to raise or lower their revenue. Let's assume your sneaker company from experience has estimated its bad debt to be a flat 3% of sales or $15,000. If your company can reasonably assume a change from 3% to 2% of sales, your bad debt figure will drop to $10,000, raising your revenue in the process. Many companies participate in what is known as income smoothing to lower their taxes, attract investors, or gain other favorable perks. But these practices are only legal if they follow GAAP. It is important that any earnings management methods are based in reasonable and truthful accounting. This means that they should stand up to an outside independent auditing firm. This prevents businesses from keeping their shareholders in the dark and crossing over to fraud. And no one wants that.